Thank you all for participating. My name is Tim Coriero. I'm the founder of Juris Wealth, and today's webinar is entitled "When Can I Retire?" Let me go through the agenda. Let's see if good. First, disclosures. My client base are attorneys, so this is pretty critical. Everything I state here is subject to all of the disclosures herein. We'll have a couple more specifics. So when can you retire? There's really two general pieces of information here. One is the core analytics, sort of the math behind retirement. And the second is some soft, more practical guidance I can offer. And really, there are different answers because there are a number of you that are on, including some of my clients, of a very wide range of ages. So this webinar is purposely general. And you're going to get different answers depending on when you're young, and let's call young something like 25 to 45 years old, in which case time's on your side and we have a very open answer. And if you're older, 45 and up, I have clients who come to me when they're in their 50s or their 60s, at which point you're much more constrained by what you have, by how much you have. And then a detailed and specific financial modeling is simply far more important because we've got to work with what we've got. Okay. But with that said, let me first sort of define the problem. The problem is simple, that you all or we all may expect to live for 30 or more years without a paycheck. Let's look at some actuarial information, and specifically at a 65-year-old married couple. The male in the couple, if you look at the actuarial tables, has about a 50% chance of living beyond 88 years old and a 25% chance of living into his mid-90s. Women live longer than men. And so if a female who's 65 years old and married today has about a 50% chance of living till they're 90, and then a 25% chance to live till they're 96. And if you do the permutations and look at them as a couple, we're talking about a planning horizon, which is really at least 30 years. And honestly, we ought to look at a 35-year plus time horizon. That's a third of a century. That's a very long time to go without any earned income. One of the things that obviously happens over such long periods of time is, even if we look at a modest inflation rate, here I'm just going to show you a 2.5% rate, something that costs $50 when you start your retirement is going to increase in cost to about $75, so 50% increase 15 years later, and will double in cost by the time you're at the end of your retirement years. What happens if inflation's higher? Let's just look at a large number. I don't think inflation is going to be 5%, but I modeled it just to make the point. Here we've got the red line, not the blue. So what costs $50 at the start of retirement at a 5% compound rate is going to quadruple in cost by the end of retirement. Again, I'm not projecting a 5% rate, but we're highly dependent and exposed to what the actual inflation rate is. End of life expenses. This is significant. Here we have a Health and Human Services study done a few years ago that says the prospect of becoming disabled and needing long-term services and supports is perhaps the most significant risk facing older Americans. And here's one fact that came out of this report. I was stunned by this. 70% of adults who survive the age 65 develop severe long-term services and support needs before they die. Now, the truth is, these support needs are often of short duration, but not always. And I can just share anecdotally, my father, who's 88 years old, is in memory care, and he's in great health. His father lived to 105. So my family is looking at 10, 15, 20 years or longer of long-term care. The monthly cost for his care today is over $10,000 a month, and that's for one person. It's devastating financially if you're not prepared for it. What about Social Security? The program was designed to replace about 40% of pre-retirement income. This isn't news to anyone. The Social Security Trust is expected to be insolvent by the early 2030s. There are ways to fix it, neither the Republicans or the Democrats are touching this with a 10-foot pole. This is too important of a voting demographic for anyone to be the first mover to suggest ways to fix it. They're all ways that can hurt you, right? Which would mean a later retirement age or before you get your benefits. Maybe some amount of means testing. So the wealthier you are, the assets that you have, maybe your benefits go down or eliminated. They could reduce your cost of living adjustments. So that's the inflation adjustments. Who knows what could happen, but I wouldn't count on it. The traditional baseline advice that I give for Social Security is to defer taking benefits until the last possible date to maximize the benefits. For those who don't know, full retirement age, or FRA, is 66 or 67, depending on when you were born. And every year you defer taking benefits, they'll give you an 8% increase in your benefit that will last for the rest of your life. So the baseline advice is typically, and certainly that I give, is if you can afford it, to wait. But it's more complicated now. And I think it's dependent on your particular circumstance, because you might make a bet that Social Security benefits are going to decline, so you're better off taking them soon. But this is a very specific, fact-dependent piece of advice. Baseline is to defer taking benefits, but it's fact-dependent. So what's the solution to this problem? You. No one's coming. It's up to us, right? That's, I think, the right philosophy. And so how do we think about when we can retire? First, we start with how much you think we'll need. And with that, the basic framework we use is something called a safe portfolio withdrawal rate. Okay. This is how much you want to receive from your investment portfolio annually in the first year of your retirement. That's where we start with the analysis. Okay. Then you multiply that number by 25, and that's your target portfolio size. It's often referred to as the 4% rule. And let me give you some examples. So if your annual spend, and I have a column on the left, is any of these numbers, you simply multiply that by 25 to get your target portfolio. So you want to take out $200,000 from your portfolio annually, you need a portfolio of $5 million. You want 400,000 to come out, you need a portfolio of $10 million. A couple of caveats. This is some basic math. We're ignoring a large number of variables here, including taxes, right? Because money can come out of tax deferred accounts or taxable accounts, etc. We're ignoring expenses, fees, etc. This is some really basic math. Now, where did this 4% rule come from? It came from thinking about what I call the luck of the draw risk, or sequence of return risk. And that is, what happens in the markets after you retire matters a lot. And that's an understatement. Okay, so let me show you some analytics here, which is assuming a 30-year retirement, which frankly could be shorter than a lot of us have. How much could we have withdrawn in the past based on having a certain amount saved? Let me show you a chart. Okay, so here's what we're looking at. The x-axis starts in 1926 and goes to 1995. What we're showing are 30-year rolling periods, assuming you have an investment portfolio. Here it's assuming we're invested 80% in equities, right? And it says, the question is, what percentage of your portfolio could you have started to withdraw and maintain at that percentage for 30 years running without ever exhausting the principal? Okay. The result is shown in a little blue bar. They're aggregated, and so we've got this spiky line. But these are rolling series of monthly analyses. So if you had retired in 1926 in January, I can't sort of plot it here, but it's roughly, you would have been able to take out 5% or more, maybe closing in on 6 of your portfolio without ever running out of money. Okay. That blue line is that 4% safe withdrawal rate. And that 4% is based on this chart, basically, because here's how to read it. So the blue line shows the annual percentage you could have withdrawn and never fully depleted the portfolio. If we look just after the Great Depression, we see that the withdrawal rate is below that 4% of the line. Okay, that would have been a terrible time to retire, just before stocks cratered. That was the worst time ever. And at that point, you would have been able to take out 3% of your portfolio from day one and continue that amount grown with inflation for 30 years and never gone broke. Another time that would have been bad to retire is in the 70s during the period of stagflation. But on average, and this is interesting, median, okay, in general, you would have been able to take out 6.7%, which is more than the 4. Okay, and I'm going to plot it there. But we're not planning on averages. Okay, we're looking at a worst case scenario, a reasonable worst case scenario for your money to last as long as possible, and that's where we get to 4%. Now, let me say something here that's important, which is the withdrawal rate assumes you have a majority stock allocation. Okay, as I said before, 80% of your money in stocks. This is what we call an 80-20 portfolio, 20% in bonds. Okay. There's your worst case scenarios, the median 6.7. What happens if we drop our allocation and we just look at 60% stocks? Well, the worst case scenarios are a little more frequent, and the median withdrawal rate, right, on average that we could take out is lower. What if we drop to 40% stocks? There's a lot more risk that we would have not been able to take out 4%. The median is 4.7. Okay. What if we just had 20% in equities? Okay. Most of the time, you would have gone broke. Okay. The median withdrawal rate permitted, if you'd had a 20% equity portfolio, 20% stocks, and 80% bonds, is 3.9%. Okay. What this analysis is not, and this is a common mistake for clients who come to me, they think you can just live off your dividends. You can't. Well, you can if you have enough money, but that's not the appropriate analysis. It's okay to spend some of your principal. This is called a total return analysis, and it's a reasonable expectation that you will sell some of your stocks and bonds over time. And why is that? Well, the current S&P 500 dividend yield is just about 1.3%. So you want to you can retire with just equities and live off the dividends if you have a lot of money. All right, probably more than most of my clients have. Bond yields are higher than that 1.27% dividend yield, but total bond returns have historically been too low to provide income for 30 years without having a much bigger portfolio. So again, I put together the following 2 pages because I think this is a really important point to hammer home. A lot of people say they don't like stocks because they're risky. Okay, again, here's the 80% stock portfolio, and there's a lot of volatility in the income that you could expect to get out of it, right? But the median withdrawal rate that you could expect from a stock-heavy portfolio is about 6.7. So people say they don't like stocks, they're risky. Let's drop our allocation and we'll have mostly bonds. This is a lot less volatile, right? But the median withdrawal rate is 3.9%. This is a core mistake people make. It depends what risk we're solving for. If you're solving for volatility risk, and it's not really risk, if you're solving for volatility, sure, go into bonds. But it's far more likely that you're going to have an issue in terms of withdrawal rate. All right, so basically pick your poison. I'm really just gilding the lily hill. Pick your poison. Get a bumpier ride and higher withdrawal rates with stocks, or a smoother ride and a lower withdrawal rate with bonds. Okay. All right, now that we've outlined what we're trying to get to, how do you get there? All right, the only way to get there is compounding returns. Okay. Here's a cartoon analysis. Let's assume you invest $1,000 when you're 25 years old and you can compound that at an 8%. This is just math. I'm not suggesting that anyone's guaranteed or will get an 8% return, but let's just compound forward 8%. By the time you're 30 years old, that $1,000 has grown almost to $1,500. By the time you're 40, it's tripled in value, more than that. By the time you're 50, you're almost up 7x. 60, you're up to almost $15,000, et cetera, et cetera. Okay. By the time you're 75, you've got almost $46,000. There's something interesting and relevant to highlight on this chart, which is this. Um, 30% of the wealth creation, so going from 32,000 to $47,000, which is basically a third of the value we're creating, occurs just in the last 5 years. Okay, a very narrow period of time. Now, why is that? I'll explain it by talking about Warren Buffett. So Warren Buffett is 94 years old. He's worth $150 billion, but 99% of his money came after he turned 50. Okay. He wasn't even a billionaire until he was 56. He was just as good an investor prior to turning 56 as he was when he was 60, 70, 80, 90. This is a function of compounding. Okay. Um, you want to be like Buffett. You want compounding to work for you, and wealth creation is always greater at the end. Okay. So, how do we get there? Here's another way to think about this, which is the future value of $1,000 invested at different ages. This is such a critical point. I want to reframe this. We can reframe that prior chart as follows, because it highlights the fact that early dollar invested are the most important. So if you invest your $1,000 at 25, that's basically worth, at an 8% compounding return, $47,000 in future dollars, right? If you invest that same $1,000 at 30, it's going to turn into 32,000. It's great, but it's not nearly as much wealth. If you do it at 35, it turns into 22,000, right? And so on. This is so critical, and when I speak to young people in particular, I can't emphasize enough the power of getting the dollars in early. It's just astonishing. So if you look at the future value at age 75 of $1,000 invested at 25 years old, it's basically worth 10 times more in terms of what it'll be worth when you're 75 as $1,000 invested when you're 55. Okay, start investing young. Right. All right. So financial modeling, how do we get there? There are several ways to do financial modeling. I like to start with an Excel spreadsheet because I call it bare bones. I want people to actually understand the math. There's just some disclosure here because it's just this is a cartoon. This is sort of cocktail napkin math, but I think it's informative. Okay, let's talk about a client who comes to me. Assume it's a married client that their ages are 35, okay? And that they have a portfolio that's going to generate a 7% compound return, just to pick a number, okay? Let's assume that their current retirement savings are $500,000, and let's look at how much they might save annually. Let's assume one of them works. Maybe they both do, but let's assume one works and they max out their 401k at $22,500, which is the limit. That's basically $1,900 a month. And let's assume on top of that, they also do an after-tax investing of $3,000 a month, which is $36,000 total, right? So every year they're putting away just shy of $60,000 between their 401k and after-tax investing, which works out to be about $5,000 a month, okay? Let's look at a wealth creation model. Okay, they're 35, they come to me, they've got $500,000. They invest 60,000. The returns that are generated, 7%, are $39,000 on that money. You total all that up, they end the year with 597, so almost 600,000, right? So they've gone from 500 to almost 600. Most of that is from contributions, but they get some amount of returns. Okay, what happens the next year? We start with that larger amount. We contribute the same amount, 50,500, 58,500, and we generate returns on that larger amount of money. So we end the year with now a little more than $100,000 of portfolio growth. We're entering at 702. We continue that analysis. I'm flashing forward to age 38 because I want to highlight something here. By the time you get to this point in wealth creation cycle, look what happens. You're still contributing the same amount every year, But your returns are larger than your contributions. I call this your tipping point, and your money is now working harder than you are. You want to get there as soon as you can. Okay. Now I flash forward. I've carried this table down. I've eliminated ages 51 to 64 just because it makes the chart too hard to see. At the end, when they're 65, there's your $10 million for the couple that wants to spend 400,000 a year. That's how you get there. 30 years of consistent savings, right, on top of an initial amount you've already saved. And if we total all up, we total the columns, the returns here are $8 million, okay, which is multiples more than the contributions. Again, your money is working harder than you. Now, admittedly, those contributions don't include the initial 500,000, but even with that, your returns are going to be many multiples of the capital you put in. All right, so that's sort of the bare bones Excel-based spreadsheet that I like to start with clients. Let's look at something a little more sophisticated. This is a financial model that I use sometimes. It's from a company called The Big Picture. And here we have on the left-hand side the assumptions. So let's say we have a planned saving period of 30 years. This reflects the model in the prior page, that you start with $500,000 and that we contribute that same annual amount here converted into monthlies, okay? And that we're trying to get to $10 million, again, reflecting the prior model. We select the portfolio they're invested in, and we have a range here which reflects different allocations to stocks for bonds, which has a resulting output of a compound annual return expectation. And in this model, again, which is a little more sophisticated than the Excel-based model, we have a range of returns, okay? It says we're unsafe. This is their output, that our odds of success of hitting that $10 million figure are only 75%. This is important because the prior Excel spreadsheet implies precision and linearity in terms of getting that same 7% net return every year. That's not how the markets work, okay? So the slightly more sophisticated analysis looks very similar to that 4% safe withdrawal rate. We look at what would have happened in prior years, right, had we been saving for 30 years running on the amounts that we put in our assumptions, right? And just like the safe withdrawal rate, it depends on market performance. The same thing is true as you're building your portfolio. Okay, so we have periods of time where the equity markets just weren't creating the growth they did, or they were in significant decline, such that we wouldn't have hit that $10 million figure. I haven't highlighted the line here. You can see it. That straight line across is that $10 million savings goal. There are periods of time where we would not have reached it. The worst case scenario, we would have been on the savings plan and only generated $6 million of wealth. I might note that even in that case, our investment returns would have been larger than our capital contributions. But on average, we would have done better than a $10 million $10 million portfolio. But we're not solving for average, right? We're also not solving for worse. Okay, so there are different levels of detail and plenty of modeling software available to do this. Now, for those who are in retirement, are we there yet, right? And so here's the core of it for my clients who may be in their mid-60s. It comes down to how much you spend. And the way to do this correctly is to actually budget and to budget in detail. Personally, I hate budgeting. I've always hated balancing a checkbook. I know that may sound odd being a financial advisor, but my philosophy is I'd always rather ensure I have more money than I would reasonably need to make sure my bills, my checks clear. But as you get closer to retirement, and if you're close to that spending threshold in your 4% analysis or any reasonable analysis, we'll talk about other approaches here. You really want to dial this in. One thing to comment, I've just highlighted housing as the first expense budgeting item because this is often the largest. Many people get myopic about a mortgage and they think they need and should pay it off by the time they retire. That's not entirely clear to me. I want to come back to that. That's an important point that I'll add later. But the different buckets are beyond housing: food, significant expense, especially if you dine out a lot, transportation, cars, car maintenance, insurance, healthcare services. These are very significant, particularly before you get Medicare. Um, Insurance can be very significant. One thing to note here, I really hope none of your line items are for whole life or universal life. I don't know any, if any of you have them, I'd be happy to chat with you about it, but I've never seen a policy make sense for any of my clients. So we'll come back to that. Personal care, family care, miscellaneous. Often there are big items in here, particularly travel and vacation, um, educational expenses as well, if you're helping the kids or even the grandkids out. This is the right way to do it, to do from a bottoms up analysis of thinking deeply about what your line items of expenses are. Okay. Now, here's another financial model that I use. This is an output from a piece of software called Income Lab, which here's sort of the key takeaway page. A projected balance. This is another illustrative client. This isn't the one trying to get to 10 million. This is someone who's projected to have $4.5 million at retirement, which is going to occur under this model in March of 2027. And the model suggests a spending capacity of $14,600 a month. If you did the math, that's roughly a 4% withdrawal rate. It's not exactly that because this model is a little more sophisticated, factors in taxes. This model also, though, includes something that's really important for those who are going into retirement, which is portfolios aren't static, right? So that 30-year analysis of just simply looking at the balance of your portfolio when you retire and thinking about what you can withdraw in perpetuity thereafter, pegged to the initial starting value, that's too simplistic. Because what happens if your portfolio doubles in value? Can't you spend more? Or conversely, what happens if it drops? The more sophisticated financial modeling tools have this element of finesse, which is called spending guardrails, is usually the term of art. And here's just a page in the model which illustrates it. So if this couple retires and instead of having 4.4 million, they end up with a portfolio of 5, well, the model suggests you could increase your spending modestly from 14,600 to 16,900. Conversely, if your portfolio is meaningfully less than you targeted, you're gonna take out meaningfully less. It's not one to one because the model is sophisticated enough to assume that if the portfolio is in decline, that the markets are likely to recover at some point, and so it takes that into account. Again, these are called guardrails, and you can sort of just visually see that your withdrawal rate can be dynamic depending on what happens to your portfolio over your retirement period. So another level of sophistication. These retirement models can be very sophisticated, which is both good and bad. The level of sophistication implies, I think, sometimes a level of certainty that doesn't exist. But I think it can be very helpful in being deeply thoughtful about specific strategies, particularly as it relates to, here's an example, your tax strategy. So let me articulate what this is. Let's assume that that you have, and this is often very common, a client might have a taxable brokerage account, a tax deferred account, which would be a 401k that they might roll into an IRA, and then maybe a tax-free account, which would be a Roth. Okay, so 3 basic buckets. Well, one of the questions is, as you head into retirement, where do you take your money out first? Okay, if you're not yet 73 years old, that tax-deferred account doesn't have to be tapped. You're not yet at a point of having to take what we call required minimum distributions, or RMDs. All right, so do you take it from a tax-deferred account? Do you take it from a taxable account? From the taxable account, which are often just investment brokerage accounts, which asset do you liquidate to actually fund that? Is it the one with the largest cap gains, the smallest? That's an easier question. So what I've circled here is the fact that these models can reflect a large range of strategies, including at the bottom, Roth conversion strategies, which is taking money from a 401k or an IRA taking it out, paying some taxes on it to get it into a tax-free Roth. And you can do that not only with the entire balance, but with just portions of the IRA, right? And you can do that strategically to fill up those withdrawals to certain thresholds of your tax brackets, okay? I don't want to get into the weeds, which I probably already have, but just to say that like there's a real level of sophistication and we can solve for any number of variables, which might be minimizing average tax rate, minimizing the total taxes you pay over your life, or at the end there, maximizing your total net legacy, right? And you get different answers depending on the strategy that you take. Um, I don't have a lot of clients who get into the weeds on this much, but I have a few. And as they get older, this is much, much more critical. And we can save people a lot of money depending on their goals. But it gets really into the weeds, and we often have to work hand in hand with the tax preparers for my clients. All right, so now let me give you some practical guidance because we've been talking about a lot of math-centric issues. Here's the first one, okay? If you're young, start saving. Be like Buffett. I'm just going to give you an anecdote. I have a client whose daughter is now a client. She's 21 years old. She's at a company. She called me about whether she should max her 401k. I said absolutely, because the returns are, that those dollars in are so much more important. And critically, it's very unlikely she'll ever tap that money, right? Because of the penalties that she would incur. She could borrow against it for a certain amount to buy a house. I don't recommend that. But this is probably the lowest hanging fruit for any of my clients who are young. The biggest bang for your buck, start investing. Okay. Investing frequency, monthly. I've been doing this long enough, and a lot of my lawyers get quarterly distributions and lump sums at the year end. It's very difficult to be disciplined with lumpy distributions. I'm an enormous fan of setting and forgetting monthly contributions. And for those of my clients who are in big law, for example, I think of these people in buckets. I have people who invest 2,000 a month, or 4,000, or 5, or 10, or 20, or even $30,000 a month for those who are making a lot of money. That regularity, where it turns in basically like a gym membership that you don't even see or think about it, or it's like your 401k, you don't ever see the money because it's taken out before. That's really critical, because what happens is if you have a big bonus, there's always a kitchen to be remodeled. There's always a new car to buy. There's always a nice vacation to go on. I see it all the time. So whatever you do, if you invest, you should invest frequently, and I strongly recommend monthly. Mortgages. I had a client recently, mid 60s, coming up in retirement, and had been spending a lot of time hammering down a mortgage, trying to get it paid off before they retire. The issue is that the mortgage rate was 2.5%, which is, if you look at inflation, that's basically free money. Okay. And if the client has the discipline, which this client does, to invest instead of hammering down the mortgage, that is a much more optimal decision. You want to be, the way I think about mortgages is you want to be wealthy enough when you're older to afford the mortgage rather than not have a mortgage at all. A big caveat. Some people just say, I just want to own my home outright. I understand that. Some people just write a check eventually and pay off the mortgage. A critical fact, you're probably all familiar with this. Houses cost expenses aren't just mortgages, right? So half or more of your housing costs can be in property taxes and maintenance, etc. That never goes away. So when people think about paying off the mortgage, you're not ending up with a house with cost-free housing. So I understand the psychic value of not having a mortgage. I think a nuanced approach and an informed approach makes sense. If your mortgage rate is very high, by all means pay it off, because you're basically earning a guaranteed return of exactly the interest rate on that mortgage on an after-tax basis. It can be great. You have a mortgage at 7%, hammer it. Whole life insurance, I should add universal life. Avoid it like the plague. I've never seen a good policy. I've never seen a fact set or scenario where any of these make sense. I'm happy to talk to people about it. Um, individual stocks versus diversified funds. I can't tell you how many people come to me from other advisors, particularly the big banks, Morgan Stanley, Goldman Sachs, et cetera, where their portfolios are made up of, a couple dozen large cap stocks. It's incredibly common. It's a very bad idea. Okay. It's called active management. Um, just 4% of all stocks basically explain all stock market returns in the US going back to 1926. Let me say that again. Just 4% of all stocks explain all stock market returns going back to 1926. You should basically own all stocks because if you think your money manager is smart enough to pick the right ones, you're kidding yourselves. The information, the analysis is incontrovertible. That skill, if it exists, and it does exist with a few people like Warren Buffett, you're going to need 20 years of returns to figure out to tease out whether it's luck or it's actually skill. Just don't do it. Okay, and most importantly, and I'll end with this because it's a little over a half hour, have a plan and stick with it. And if you don't have a plan, get one. So that is all I have today. Apologies I went over. If you're my client, thank you for participating. If you're not a client, you should be, and give me a call and be happy to chat. Thank you for your time.